Mitch on the Markets, a conversation about the issues and trends affecting investors with Mitch Zacks, Senior Portfolio Manager at Zacks Investment Management. Mitch, even though it's hard to call the market at this particular juncture, are you encouraged by the recent better-than-expected earnings reports that have come out in the past few days from the financial sector?
I think, when you saw Wells Fargo report, the earnings was very, very strong. They signal that they're raising their dividend, and generally companies will not raise their dividend unless they're very, very comfortable that they're going to be able to pay that dividend, especially in that current environment. Mm-hmm. That caused the largest rally in bank stocks that occurred in the last 2 decades. It's easy to get roped in by that and say, listen, now's the all clear in financials and let's move more money into financials. I am encouraged because that is an indication that perhaps the credit problems are not as bad as people in the dark are imagining. Additionally, more importantly, you've seen a pullback in oil prices. So, and at the same time, you've seen some indication that the housing decline is going to bottom. So effectively what we're seeing is by no means is, Wells Fargo doing a great job, and no means are they executing very well, but it's not as bad as are built into worst case expectations. And no means are oil prices low, but they may not be going up as high as people were anticipating, given the current run-up. So both of those are very, very positive for the market. Like I said, all we need of these 3 factors weighing on the market, we need 1 or 2 of them to lessen slightly, and this market will be heading higher. And it's a very clear indication. As you saw, the other big news was the SEC came in and indicated that they're going to prevent shorting without naked. You can prevent naked shorting of financials and some other firms. Mm-hmm. And it's a very clear indication that that's the reason why over time it's very, very hard to be short the market, is because people are working to increase their earnings at these companies, working to adjust to the economic situation, and they're able to effectively accomplish that over time. They've been able to effectively accomplish that historically in the face of massive odds, and they're going to be able to accomplish that going forward. So that over time, it's very interesting with the market. Predicting it over the next month, the next 3 months, there's a little bit of cloudiness there. I still think that we are heading upward. But if you extend the horizon, you look out 3 years, 5 years, it's very, very clear that now is when you should be dollar averaging, if not completely buying the market for returns over the next 3 to 5 years. So you know where the story ends. It's the curves around the story that are hard to predict. But the story ends 3 to 5 years down the road with the market substantially higher than where it is and with these problems essentially lessened.
So has the market made an intermediate term low?
I would say that when the SEC comes out and starts changing the guidelines to affect short sellers, it's a very clear indication that on an intermediate term I would expect some strength going forward, and we have seen a bit too far of a sell-off, and that I am bullish going forward for the next couple of weeks. And I am certainly bullish when you take the longer term horizon, that if you look out 3 to 5 years, now is an excellent, excellent time to be purchasing stocks. You have to understand the major trade most proprietary trading firms have been put on, and the proprietary trading desks of most investment banks have been putting on, has been to be shorting financials and going long energy. Mm-hmm. So what they've been doing is they've been shorting investment banks, they've been shorting Fannie Mae, and they've been going long energy either in the commodity space or in companies that are energy producing companies. And that trade's completely reversed itself over the last 2 days. And that's a very, very good indication to me that the reversal may have some legs, and we may start to see some bottoming in terms of equity prices.
So in terms of the financials, just to kind of follow up, are there bargains there at this point, or is it still too soon to be?
The problem with financials is no matter what financial it is a black box. Not all financials are like this. Some financials simply take revenue in on one side, but most financial firms operate. They have a source of funding and they have a source of return on assets. Mm-hmm. And they make the difference between the source of funding and the source of the return on assets. And that difference is very small. It's a couple hundred basis points. It's not massively huge. And the reason is because in order to increase the source of funding, they have to increase the source of assets. And they're making the spread between these. So at the end of the day, all financial firms are very opaque. They're black boxes of people with various cultures, with different sources of funding and different returns on assets. What happened with Bear Stearns is the source of funding was taken away. So when the source of funding is taken away, they have a fire sale on the asset side, they become illiquid essentially, or essentially they can't continue to function. So I don't like financials overall because of this opaqueness and because of the instability caused by fluctuations in the capital costs essentially. And we tend not to be overweighted in financials as a firm. That being said, in the dividend strategy that we're running, we are moving more and more towards financials because we are seeing there a bit of an opportunity here in terms of the valuations, that if it's not as bad as worst case scenarios are predicting, you're going to see a significant jump up in some of these financial prices.
Small caps have been doing good lately. Is it a time to take a look at them?
Small caps generally lead out of a recession. The other advantage of small caps is that small caps are more dependent upon bank financing for growth. So if you have instability in the financial markets, it's going to hurt smaller cap stocks slightly more than larger cap stocks. The other issue is that small cap stocks tend to be benefiting more from lower oil prices than larger cap stocks as well. They tend to be more manufacturing based. They tend to be a little bit more regional bank in nature. So generally speaking, a lot of the dependence to move into smaller cap stocks is dependent upon where we are in the economic cycle. And I believe that we're coming out of it, so I would be overweighting smaller cap stocks at this point in time.
Your reaction to Fed Chairman Bernanke's latest assessment of our economy?
He came out and he said, listen, things are not very rosy, and there are two problems weighing on the economy. One is the potential of inflation, and the other is the potential of slowing growth. Generally speaking, I expect him to err on the side of protecting